Hello everyone, welcome to today's class. Hope you are doing good. And today International Accounting Model 3 is the same we're going to see consolidation accounting. Okay, before that we have to know what is consolidation accounting. The process, okay, what is the process of consolidation accounting? So this is based on the process of combining the financial results in a several subsidiary companies which has several companies into the combined financial results of the parent company. So from parent to subsidiary. So once the 50 percentage of shares acquires the equity, more than a 50 percentage have the parent company. So for example, if A is having 80 percentage, B is having 20 percentage, means 80 percentage the company A will be in a parent, B will be in a 20. So means subsidiaries. Okay, they have to find A company's consolidation, B company's consolidation. After that only they will make the combined financial results of the company. So this method is typically used when the parent entity owns more than 50%. I already said of the shares of another entity. So the following steps document consolidation accounting process flow. The first one is record intercompany loans. So which means that if the parent company has been consolidating the cash balance of subsidiary of B, okay, into an investment account, it record intercompany loans. It has to record the loans from the subsidiaries to the parent and interest income allocation of the interest earned in the consolidation investments for the parent company down the subsidiaries. It has to measure. And then second one is charge corporate overhead. So which means if the parent company allocates its overhead cost to subsidiaries, it should calculate the amount of the allocation and charge it to various subsidiaries. So this is the corporate overhead charge. Third one is charge payable. So if the parent company runs consolidated, okay, the payable operations, it should be verify all the accounts payable recorded during the period have been appropriately changed the various subsidiaries. If A company has a B and C two subsidiaries, means this has to check the period have approximately charged to the various subsidiaries. Okay, and the fourth one is charge payroll expenses. So which means if the parent company has been using a common paymasters system, means a common paymaster system. So to pay all employees throughout the company, ensure that the proper allocation of payroll expenses. So this has been made to all the subsidiaries. Okay, the fifth one, complete adjusting entries. So which means at the subsidiary corporate levels record and adjusting entries needed to properly record the revenue and expense transactions in the correct period. So this is the fifth one. And the sixth one, investigate assets and liability equity account balances. So which means this has to verify that the contents of all the assets, liability, equity assets for both the subsidiaries and corporate parent are correct and adjust as necessary. And seventh one is review subsidiary financial statements. So which means this has to print and review the financial statements for each subsidiary and investigate any items that appear to be unusual or incorrect. So it should make a adjustment as a necessary. And the next one, eliminate intercompany transactions. So which means if there have been any intercompany transaction, reverse them at the parent company level to eliminate their effects from the consolidated financial statements. And the ninth one is review parent financial statements. They have to review. Okay, the print and review the financial statements for the parent company and investigate any items that appear to be unusual or incorrect. It should make adjustment as necessary. And tenth one is record income tax liability. So once they are maintaining all the informations which are based on a financial means, they have to record the income tax too. So based on the profit. So it may be necessary to do so at the subsidiary level as well. And the next one is close subsidiary books. So which means it's depending upon the accounting software in use, it may be necessary to access the financial records of each subsidiary and flag them as closed. So this prevents any additional transaction from being recorded in the accounting period, which is closed. Okay. Then the next one, close parent company books, means the flag parent company accounting period as a closed. so that no additional transactions can be reported in the accounting period if it is closed. Okay. Then finally, issue financial statements. So which means it is a print, distribute the financial statements of the parent company. They need to check the parent company financial statements. So by this, if the subsidiary uses a different currency as its operating currency, an additional consolidation accounting step is to convert its financial statement into the operating currency of the parent company. So given the considerable number of steps, it is useful to convert them into a detailed procedure which the accounting department should follow rigorously as a part of closing process. So otherwise, a key step could be missed which would throw off the financial statement result. So some of the tasks noted here and can be automated or at least made simpler. So in order to produce a financial statements more quickly, however, to some degree or higher level precision required to produce more accurate financial statements requires. So additionally, consolidation effort and therefore more time. So these are the consolidation accounting process. And the next which we're going to see is foreign currency translations. Okay. So why before that we have to know what is foreign currency translations. So for example, the part of financial record keeping. Okay, so you will be using different countries in your business operations. So however, when it comes to your accounting, so your financial statements have to be recorded in single entry. So that this is why you need to perform a foreign currency translations. The meaning for a currency translation is the accounting method in which an international business translates the results of its foreign subsidiaries into a domestic currency terms, so that they can be recorded in the books of accounts. So in foreign entities owned by your business, keep their accounting records in their own currencies to apply the appropriate method of these investments. So you must translate the financial statements from the foreign currency into domestic currency. That we must translate. Okay. Then next we're going to see foreign currency translation process. How the process will be in a foreign currency. So first in that, determine the functional currency of the foreign entity. How will we determine? So before that we have to know the business must determine a functional currency of reporting. So the functional currency is one which the company uses the majority of transactions. So you can choose the currency of the country where your main headquarters are located or where your major operations are. Okay, so this can be difficult to determine when you conduct an equal amount of a business in multiple countries. So however, once you chose the functional currency, changes to it should be made only when there is a significant change in circumstance and economic facts. And the second one in this, remeasure the financial statements of foreign entity into the functional currency. So how will they remeasure? So based on this, the transactional financial statements into domestic currency begins with translating the income statement. So items are converted according to the weighted average rate of exchange. So it is vital that you keep a close eye on the dates which any of the above transaction occurred, although most currency translation occurs at the financial year end. So the exchange rates are determined by the transaction date in some instance. So bank statements and income records help you to determine the right rates. Okay. Third one, record gains and losses on the translation of currencies. So how it will be in translations. Based on this, the gains and losses arising from a foreign currency transactions that are recorded and translated at one rate and then result in the transactions at a later date and different rate are recorded in the equity sections of a balance sheet. By this next which we are going to see foreign currency translation method. So which means it is a exchange rates or constantly fluctuating. So it can cause difficulty while accounting for foreign currency translation instead of simply using the current exchange rate. So business may look at the different rates either for a specific period or specific date. So this is the thing. And the current rate method, which means using this method of translation, most items of the financial statements are translated at current exchange rate. So this asset liabilities of a business are translated current exchange rate. Since this can lead a volatility associated with the changes. Okay, it gains and losses associated with the translation are reported on a reverse reserve account instead. So this is the consolidated translation process, foreign currency translation process. And next one is temporal rate method. So how the temporal? Temporal means a temporary, okay, also known as a historical method, because it should adjust income generating assets on the balance sheet and related income statement items using the historical exchange rates. So from transaction dates from the date that the company last assessed the fair market value of the account. So the next one is monetary non-monetary translation method. Okay. So which means this method is used when the foreign operators are highly integrated with the foreign company. So the method translated monetary items such as a cash, accounts, receivables using the current exchange rate, and translate non-monetary assets and liabilities. So including inventories and property using the historical exchange rate. So these are the foreign currency translation methods. Okay. The next which we're going to see is foreign currency translations. So which the meaning was foreign currency transaction means it is a translation. Okay. There are two accounting events, okay, in which the entity must deal with the foreign currency translation. So in this purchase, sales, cash receipt, cash payment, investment, other individuals and financial transactions in currency. So other than the functional currency of the entity, accounting for these transactions, foreign currency translation. So by this conversion of the financial statements of foreign currency means subsidiary or a branch upon consolidation in the consolidated financial statements. So this is the foreign currency translations. And the financial transactions means a company needs to decide on its presentation currency. So this is a currency that is functionally means logically based on economic environment in which this company is operating. So means foreign currency remeasurement. Okay. By this it's mainly equity. Okay. So equity nothing, the company's investment, equity shares. Okay. By this the foreign exchange, okay, foreign exchange translation results loss or profit, the result from the translation upon the consolidation are recorded in the equity component in the consolidated financial statements of the parent company in the form of separate reporting line called translation reserves. Okay, translation reserves. By this it's upon liquidation or a sale of investment in a foreign currency, the amount attributable to the entity and accumulated in the translation reserve component of equity is reclassified to retained earnings or other reserves in the equity sections. So in addition, it is considered as a part of the profit or loss on liquidation or a sale of the investment in a foreign currency entity. So it is income statement for the period of occurrence of the sale or the liquidation. Okay. So by this the translation adjustment should not be included in income statement before being realized. So however, if reassessment from the recording currency to the functional currency is requested before the translation, so the profit or loss is replicated in the income statement foreign currency translations. And the next into this other movement schedules. Other movement schedules is it is a financial statements include movement schedules for non-current financial components in the consolidated financial positions. So upon translation and consolidation of subsidiaries with functional currencies different from the consolidation currency, such movement schedules also show a separate reporting line, so which called translation difference or something similar. Here the difference between the operating foreign exchange rate and closing foreign exchange rate is recognized. So by the difference only they can check the moment of financial profit or losses. Okay. So next one is determination of functional currency. How the functional currency determined. Okay. So in this, the financial results and financial position of the company should be measured using its functional currency. So which is the currency that the company uses in the majority means business transactions. So by this, if a foreign business entity operates primarily within a one country and is not dependent upon the parent company, so its functional currency is the currency of the country in which its operations are located. So however, there are other foreign operations that are more closely tied to the operations of the parent company. And probably the dollar means these two example anchor the ends of the continuum on which you will find the foreign operations. So the functional currency in which a business reports its financial results should rarely change. A shift to the different functional currency should be used only when there is a significant change in economic facts or circumstances. The next one is this example of a functional currency determination. So which means uh, Armadillo, okay, also owns a subsidiary in Russia. Subsidiary means uh, Armadillo have a parent and Russia in a subsidiary, okay, which manufacture its own body armor, body flavors, so accumulates cash reserves and borrow funds locally. So the subsidiary remits funds back to the parent company. So for the parent company, the subsidiary goes to this. So in this case, the functional currency should be in Russian ruble, okay. Then translation of financial statements and rules for translation financial statements. What are the rules? So based on this, translation is a financial statement of an entity for consolidation purpose into the reporting currency of a business. So in this, translate the financial statement using the following rules. Based on this, the first rule is assets and liabilities. So in assets and liabilities, which translate using the current exchange rate at the balance sheet date for assets and liabilities. And then second, income statement, so which translate revenue, expense and exchange rate recognized when it's originally recognized. Allocations means the allocations using where the depreciation will and amortization, deferred revenues and all goes to the allocation. And then next which we gonna see is segment reporting. So it has defined the segment of the business and component of the entity whose activities represent a separate major line of a business or a class accounter. Okay, so a segment may be in a form of subsidiary or a division of a department, and in some cases joint venture or non-subsidiary investee. So provided that it assets results of operations and activities can be clearly distinguished physically and operationally and for a financial reporting purpose from other assets, results or operations and activities of the entity. So by this, the segment under this segment is business segment. So business segment means it is the part of enterprise that is involved in a providing individual product or a service to a group of related products. So this service that is subject to a risk, a return that are different from those of other business segments. The second one is segmental, geographical segment. So which means it is distinguished part of enterprise that is involved in providing products and services. So by based on product and services it is involved. And the next one, reportable segments. Under reportable segments, it means it is a business segment or a geographical segment. Identify based on foreign definitions. Okay. So under this, next, terminology of segment reporting. Terminology means closing existing, okay. It is a terminology of segment reporting. Under this first one, segment revenue. So segment revenue means it is reported in a statement of profit and loss, okay, that is directly to a segment and relevant portion of an enterprise. It may be a revenue, can be allocated in a reasonable basis or to segments. So whether from say sales external customers or from transactions with other segments of the same enterprise. Okay, in the segments revenue which does not include means extraordinary items and interest dividend income, including the interest earned, advances, loans, and these are not included in a segmental reporting. Okay, and finally gain on sale of investment or a gain on is extinguished debt. Okay, with this also not included in segment revenues. Next one is segment expense. So which means it is an expense resulting from the operating activities of a segment that is directly attributable to the segment and relevant portion of expense that can be allocated a reasonable basis to a segment. So which include expansion expenses relating to sales and external customers, and expenses relating to transactions. Okay, so under this, the first one, extraordinary items. Second one, interest, including interest incurred on advances and loans from other segments unless operations of the segment primarily of a financial nature. Third one, losses on sale of investment and losses on debt. Okay. Fourth one, income tax expenses. Fifth one, administrative expenses, head office expenses, other expenses. And next one is segment result. So which means this result means segment revenue less segment expenses. Okay. And segment assets. So which means those operating assets that are used by a segment in its operating activities, so that either are directly attributable to the segment or can be allocated to the segment on a reporting reasonable basis. Okay. Then segment liabilities. So which means the liabilities are those operating liabilities which results from the operating activities of a division. Okay, and either are directly attributable to the division and can be allocated to the division on a reasonable basis. And the next which we're going to see is segment accounting policies. So in this, the segment accounting policies are accounting policies framed for preparing and presenting the financial statement of an enterprise. So as well as those accounting policies that relate to specifically to segment reporting. So these are the terminology of segmental reporting. So by this, based on the financial translation is, if the translation adjustment resulting from the implementation, okay, the record adjustment in shareholders equity sections of the parent company consolidated balance sheets. So if the process converting the financial statement of a foreign entity into the reporting currency of a parent company, the results in a translation adjustment, it reports related profit or loss in other comprehensive income. So these are known as the segmental reporting. So by this class is over. If you have any queries, please let me know in your in my WhatsApp. Text me in a WhatsApp. I can clarify your doubts. Thank you. We'll meet in next video.